Hi there, thanks for stopping by. In today's video, we'll be looking at tax-efficient ETF strategy. 3 low-volatility funds for recession resilience and tax loss harvesting. Before we dive in, if advertisements should interrupt this video, please do not click off of the advertisements. Please allow them to play through as a thank you to me for bringing you this honest, valuable information for free. Now let's continue. Every year, too many investors make the same fundamental mistake. They chase market highs in their taxable brokerage accounts, and when the inevitable volatility hits, they panic, selling at a loss without a coherent strategy. This destroys wealth not just through principal loss, but through unnecessary tax drag. You deserve better than reactive investing. Today, we are moving past guesswork and adopting an authoritative, proactive strategy. This is the tax-efficient ETF strategy, building genuine recession resilience using 3 specific low-volatility funds and integrating the single most overlooked strategy for wealthy investors: 2026 tax loss harvesting. This isn't just about reducing risk. It's about turning volatility into a tax asset, a critical part of your long-term 401k and Roth IRA allocation planning. Defining the core transformation, tax alpha. To truly master this, we first need to understand the central problem, tax drag. When you invest in a typical mutual fund or a high-turnover ETF in a non-retirement account, you are often hit with a year-end capital gains distribution that you must pay tax on, even if the fund had a poor year. This is the financial friction that erodes your long-term returns. The transformation starts with understanding ETFs, exchange-traded funds, are structurally more tax-efficient than traditional mutual funds due to the in-kind redemption process. This is what allows them to distribute fewer capital gains, keeping more of your money working for you. Our goal is to generate tax alpha, the added return you get purely from smart tax management. The foundation of our defensive posture is using low-volatility funds. These aren't fancy, complex instruments. They are ETFs designed to hold companies whose stock prices fluctuate less than the broader market, typically in defensive sectors like utilities, consumer staples, and healthcare. During instability, these sectors maintain earnings because people don't stop buying toothpaste or paying their power bill. The 3 low-volatility funds for defensive allocation. Now for the actionable strategy. We are selecting 3 funds to form a robust, defensive core allocation. We need to look beyond the ticker and analyze the expense ratio and the specific sector exposure to maintain portfolio integrity. ETF number 1. The Core Defensive Shield. The sector play will start with the Consumer Staples Select Sector SBDR Fund, XLB. Consumer staples companies, think food, beverages, household products, have historically been the ultimate ballast in a portfolio during a downturn. Their earnings are inelastic to economic cycles. The expense ratio on this fund is extremely low, a non-negotiable factor in any long-term, tax-efficient strategy. This is your anchor, providing high-quality earnings stability and a respectable dividend yield. This fund is ideal for placing in your taxable account because the low turnover means low surprise capital gains distributions. ETF number 2. The Volatility Hedge. The factor play, our second choice, is a factor-based fund, like the iShares MSCI USA Min Vol Factor ETF, USMV. Unlike a sector-specific ETF, USMV uses a quantitative model to select the 100 to 200 stocks across all sectors with the lowest realized volatility over the past year. This is a sophisticated way to achieve downside protection without completely abandoning growth sectors. This fund strategy is designed to create a smoother ride than the S&P 500, a crucial psychological and financial hedge for investors in the high tax brackets. ETF number 3. The ultimate ballast. The Treasury play for true recession resilience. You must have assets with a negative correlation to the stock market. That leads us to the iShares U.S. Treasury Bond ETF GOFT. U.S. Treasuries are the classic flight to safety asset. When stocks fall, investors flood into Treasuries, driving their prices up. The real value here is twofold: risk diversification and a secondary function in tax loss harvesting. This bond allocation acts as the unshakable foundation for your entire portfolio during high market stress. Implementing 2026 tax loss harvesting. The Alpha Generator. This is the segment that elevates this content to a high-paying strategic review. The real transformation isn't just buying these ETFs. It's using them to systematically reduce your tax bill. Tax loss harvesting is the practice of selling an investment that has lost value in a taxable account to realize a capital loss, which you then use to offset capital gains you've realized elsewhere, or up to $3,000 of ordinary income. Our 3 low-volatility funds are perfect harvesting tools because they allow for the wash-sale rule workaround. If you sell a losing position in a large-cap growth fund, you cannot buy the exact same fund back within 30 days. However, you can immediately use the proceeds to buy a similar, but not substantially identical, fund like the USMV or XLP. This allows you to maintain market exposure and your desired asset allocation while immediately generating a tax asset. The most sophisticated investors perform this throughout the year, not just in December. By using this proactive tax loss harvesting schedule, you compound the tax savings, leaving more capital in your taxable account to grow, making a monumental difference over decades. The risk, warning, and compliance section. Before you implement this tax-efficient ETF strategy, here's the mistake that could cost you thousands in IRS penalties: violating the wash sale rule. You cannot sell a security for a loss and buy a substantially identical one 30 days before or after the sale. If you do, the loss is disallowed. While the IRS has never given a definitive opinion on what constitutes substantially identical for 2 different ETFs tracking the same index, the safest move is to switch strategies. Sell a total market fund, buy a low volatility fund. Sell a technology sector fund, buy XLP. Always consult a qualified tax professional or CPA before making significant harvesting moves. Furthermore, remember that even the lowest volatility funds are subject to market risk and the possibility of principal loss. Conclusion and transformation. You came here looking for a defensive portfolio. You're leaving with a tax-efficient investment system. The transformation is moving from simply hoping the market is kind to utilizing the tax code and structural advantages of ETFs to optimize your after-tax return. This tax-efficient ETF strategy, using low-volatility funds, is your plan for recession resilience and long-term wealth accumulation, especially as you strategically manage your 401k and Roth IRA allocation alongside your taxable account. Take control of your portfolio's biggest enemy, taxes, by implementing these 3 funds and the tax loss harvesting framework. If you found the analysis of the expense ratio and the wash sale rule valuable for your financial plan, then do the next logical step. Hit the like button and leave a comment below telling me which one of these 3 defensive funds you plan to add to your portfolio first. Also, subscribe now to ensure you don't miss the next deep dive into optimizing your long-term wealth strategy.